Looking to set another record high, 30 minutes until the start of the cash trade. I'm Matt Miller. Dani Berger is on assignment. She's at Citadel's Future of Global Markets conference. We'll check in with her later this hour. Bloomberg Open Interest starts right now. Coming up, this market is experiencing signs of fatigue. The AI-driven rally hitting extremes, with Citi warning that investors may soon start cashing in. OpenAI cementing its role as kingmaker, but the stock moves driven by the company are giving traders.com flashbacks. And Citadel billionaire Ken Griffin says he's concerned about the U.S. economy on a sugar high and calling the rush to gold really concerning. Let's check out some of the stocks that we are keeping an eye on this morning. Dell Technologies is one of those right now, up 7% in the pre-market after it roughly doubled its growth estimates for sales and profit in the next 2 years, citing demand for AI products. IBM also up in the pre-market, will integrate Anthropic's Claude family of large language models into its software portfolio, and AMD still riding high off that OpenAI data deal. AMD is going to give 10% of itself to OpenAI to get OpenAI to buy chips from it. For more on the AI trade, we are joined by Bloomberg Tech's Ed Ludlow, co-anchor of that program that kicks off at 11 o'clock. Ed, so much going on, but let's kick it off with Dell. What do we know?
Sure. Yeah, very simply, they're basically roughly doubling their outlook for sales and earnings through fiscal 2030. So top line growth is going to be between 7 and 9%, EPS growth 15%. But the story's kind of changing for Dell. So in the build out of data centers and infrastructure, somebody's got to put the server design together. And that's basically what Dell does. And right now, that's kind of a mid-single digits business, in part because of how aggressive the rollout is. Somebody's got to take a hit on the profitability. And it seems like that's been Dell until this point. But they are saying that the profitability on AI servers is going to improve. And so the stock clearly is reacting very positively to this. They have a lot of key customers, CoreWeave, xAI in the private sector. But traditionally, Dell is also very good at selling into the public sector. And a part of what the story they're telling about that pathway through to 2030 is that, as governments spend more on AI, they will also be there or thereabouts in it too.
Sorry, Ed, there's a lot more going on than just Dell. We've got news coming out from Tesla a little bit later. What we expect in terms of new models?
Yeah, what I'm hearing from sources inside Tesla is that this, whatever comes today, however it comes, because we don't know how Tesla's going to announce this, is a more affordable version of the Model Y. I have no idea on the specific price point of it, but what I do know is that the focus for an affordable Model Y has been about taking and engineering the cost out of the battery pack and engineering the cost out of the motors. What they focused on is basically going to their suppliers for lighting, for example, and being like, can we get some cheaper lighting? Teslas, as you know, have very few sort of panel controls because of the touch screen. But my understanding is that this vehicle will also have a much lower feature count and a much more simple control panel. But again, we have no idea how they're going to announce this thing. What I'm told by folks at Tesla is there's not going to be some kind of big event. It may just get listed on the website. But this is the one everyone's been waiting for, because post-federal tax credit of $7,500, everyone's asking how Tesla maneuvers in the lower end of the market, something that they've discussed in quite a lot of detail on the most recent earnings calls.
Right. Ross Gerber from Gerber Kawasaki says it's going to be a Model Y that's less good for less money. Let me finally ask you about IBM, because they have another partnership, this time with Anthropic, that's boosting their stock in the pre-market. So everybody wants to get in on this momentum, I guess, while they can.
Really simple story. IBM has software offerings. They're going to make Claude models available, particularly through what they call integrated development environment, or IDE. It's basically a platform for developers. Claude is one of the leading frontier model shops. Their competence in LLMs far exceeds IBM's competence in LLMs. And so, it's like this idea of the golden ticket trade. A partnership with the leading names in AI has boosted some of the legacy names. And it's a very simple story. IBM is basically a sales channel for Anthropic, but it also makes what they're offering more attractive. And they have a community of about 6,000 software developers that use their software portals. Simple as that, and the stock is up significantly, 3% or so in pre-market.
All right, Ed, looking forward to your program. Ed Ludlow there, co-host of Bloomberg Tech with Caroline Hyde. Also moving this morning is a decidedly non-tech company, Constellation Brands. It owns Corona and Modelo beers. It reported better than expected results as beer and wine sales outperformed the broader industry. Bloomberg intelligence analyst Ken Shea joins me now. And Ken, I thought people were drinking less, or at least less of these traditional lower alcohol beverages, going for the higher end liquors or even like THC infused beverages.
Hi, Matt. Well, some of that is true. Premiumization was a big buzzword in the alcoholic beverage business for many years, up until a couple years ago, when consumers decided to search for value. A lot of theories about it, but I think it could be very well. The cumulative effect of inflationary pricing over the last few years has been pretty aggressive. So now Constellation came out last night, and they said that beer volumes were down about 8.5%. And as awful as that is, it's not as bad as the 9 to 10% that analysts were expecting. So that's why you've seen a little relief rally today. But to take a step back, the pressure is still on the company's beer business. As you said, it's mostly Modelo and Corona, two high-priced, premium-priced beers that have a very loyal following. But right now, the U.S. beer industry is really in the doldrums, where volumes are down, low single digits, and this company is not immune to that.
So does Constellation have plans to expand into other higher growth or any growth areas?
Well, they would argue that Corona and Modelo have a bright long-term future. They believe that the near-term pressures will ease up at some point, and consumers will, resort back to their old habits. I'm a little more skeptical. I think there's more structural issues going on here. I mean, some of the things that we've talked about, substitution of cannabis, GLP-1 users drinking less, moderation in general, are likely to weigh on this industry for a while. To the degree, no one really knows. What's the company doing about it? Well, it's rolled out Corona No Alcohol. It's come out with Modelo Oro, a 90-calorie version of Modelo. So it's doing what it can do, but, now that it's downsized the wine and spirits segment, about 85–90% of the company's sales is beer. So there's not many places where it can run. It just has to do as best that it can in a troubled industry at the moment.
All right, Ken, thanks for joining us. Ken Shea there of Bloomberg Intelligence. You can find his work on the terminal. If you type in STZ Equity BICO. BICO is a command to find any Bloomberg Intelligence analyst covering any specific stock. Let's get to the ICE deal, and I'm not talking about immigration. The owner of the New York Stock Exchange plans to invest as much as $2 billion in cash and crypto-based betting platform Polymarket. Shares of Intercontinental Exchange, the original ICE, are higher on the news. ICE and Polymarket have agreed to partner on future tokenization initiatives. Bloomberg's Sally Bakewell leads our U.S. finance coverage. A lot of this stuff, if I were saying these words a few years ago, I wouldn't have believed it was a real story. But so this is happening. Like the operator of the floor is going to move towards tokenization.
Well, this is yet another example of traditional financial firms embracing the new guard, embracing the crypto players and embracing the prediction markets under this more friendly regime under President Trump. And anytime a storied institution like ICE, which owns the New York Stock Exchange, anytime that it puts a huge amount of money, $2 billion, into a business, it lends credibility to that business. And we could argue that Polymarket has been seeking to boost its credibility in the US because it was actually banned from US users in 2022, subject to probes examining whether it continued to allow US users to use its platforms, and those probes were dropped earlier this year. Again, another example of authorities under Trump reversing course on Biden-era actions.
Is something like Polymarket useful to investors? Has it been more and more popular?
Well, this is part of the deal. Polymarket, through this deal, it gets this direct channel to institutional investors who trade on NYSE. And then likewise for ICE, for NYSE, they get access to Polymarket's customers. So it's a great deal for both.
All right, Sally, great having you on the set. Thanks so much for joining us. Bloomberg Sally Bakewell covers finance for us. Get a quick check on futures. We are 21 minutes away from the opening bell, and we're looking at gains again here. S&P futures up 0.2%, NASDAQ futures gaining a third. Coming up next, we go live to the Greenwich Economic Forum, a special conversation with the founder of Bridgewater, Ray Dalio. He sits down with Bloomberg's Lisa Abramowitz. And later this hour, we'll head to Citadel's Future of Global Markets conference right here in New York City. My co-host, Dani Berger, sits down with former World Bank President David Malpass, followed by a conversation next hour with David Marcus, the CEO of LightSpark. This is Bloomberg Open Interest. Let's get to high interest now. Look at what's making headlines around the world. The World Trade Organization says the global goods trade will slow down sharply next year after a surprisingly strong first half of 2025. Merchandise trade is now expected to rise 2.4% this year, but just 0.5% in 2026 as President Trump's tariffs take fuller effect. The WTO says much of this year's strength came from surging shipments of AI-related products, even as trade and everything else barely grew. The White House is considering not paying federal employees for days they have been furloughed during the shutdown. It's a move that could run afoul of a law that mandates workers get back pay once the government reopens. Yesterday, President Trump said he was open to negotiating with Democrats over health care subsidies to bring an end to the funding standoff, but hours later, he reversed that position. Carlyle Group is filling in the data gap left by the U.S. shutdown, estimating that just 17,000 jobs were created in September, one of the weakest gains since the 2020 recession. The firm's private data shows a cooling labor market, even as other indicators suggest the broader economy remains resilient. And JPMorgan is footing a $115 million legal bill for two executives convicted of defrauding the bank, including Charlie Javis, who is now serving 7 years in prison. A Delaware court ruled JPMorgan had to cover legal costs tied to its $175 million purchase of Javis's company, Frank. The tab is almost 2/3 of what the bank paid for the deal. To put the $115 million figure in perspective, a high-priced lawyer billing $2,000 an hour would have to bill 8 hours every day, including weekends and holidays, for nearly 20 years to reach that total. But of course, a high-priced lawyer would bill far more than 8 hours in a day. All right, happening now at the Greenwich Economic Forum, Bloomberg's Lisa Abramowitz is speaking with Bridgewater founder Ray Dalio. Let's take a listen.
Credit, and look at where the credit spreads are. Credit spreads are very, very low. And so for those various reasons, my tilts would be away from those things.
And toward gold.
But again, yes, so more than would be a normal asset allocation mix. But I think you have to also say, start with what is a real dollar, if you're a dollar investor, a real return asset that you're going to hold as part of that portfolio. The most of the system is dependent on credit. Equities and everything is dependent on credit. You change credit and, then all sorts of things happen. And so it's an effective diversifier as well as probably the timing seems good.
Going to the 5 tenets that you were talking about, given the imbalances in the deficit, in the debt load, and the amount that people are going to have to sell, governments are going to have to sell, do you think it's appropriate for the Fed to be cutting rates right now?
I think the picture on cutting rates is slightly mixed. And it has to do with the split in the economy, and it has to do with split in capital markets, which means you're trying to look at the economy as a whole. But what you have is in certain sections of the economy, you have an enormous amount of liquidity, enormous amount of wealth, things are like if you're in the top 1% of anything, you know, or which is the top 1% of the income earners, the top 1% of the stocks, and AI and so on and so forth. Wow, there's a tremendous amount of liquidity and fantastic. And so you would say, if anything, you'd worry more about the bubble and how you start to pull the, you know, the punch bowl, that kind of thing. But we have a very diverse economy. So if you're looking at, let's say, the bottom 60% of the population and the conditions of the bottom 60% of the bottom population and labor markets and so on, then you have a very, very different issue. I don't think monetary policy at all is going to be able to do that. I think that there's a strong situation where, you know, the natural instinct is if things aren't exactly like I would like and I'd like to make them better, I should ease monetary policy. Okay, so I mean that's now, we've learned that, right? Because every time you do that and then things go up and people are happy and so on. But there's a cost in doing that, right? The cost in doing that is that there's, you know, one man's debts are another man's assets. And so when you artificially lower the interest rate so that it is not attractive, in a sense, to hold as an asset, and it's very attractive to borrow and buy things, that creates an imbalance. So I think that I think that discipline is not something that anybody seems to want, and yet I think it's needed. So when I think about the monetary policy and so on, I think not much, if any, but I also think it's not really dealing with the whole so well because of the disparity in the parts.
Going back to the video that you showed first, you're talking about these 250-year cycles and then 10 to 20-year periods where there's a transition of a power from one to another nation. And I just wonder if you see things the same way this time, because it seems like globally there are the same issues everywhere in terms of these imbalances and in terms of the deficit, in terms of nobody really wanting to take the punch bowl away at a time of increasing distress in certain pockets. Do you think it's different? I think,
and just to be clear, that's the whole cycle of the Great Cycle. In there are breakdowns of orders, right? So 1944, we had the breakdown of the monetary order. We had another breakdown in 1971, all right? So 1945, we had the breakdown of the most countries' political orders and most countries' geopolitical order, right? So we have those cycles, which are part of then the overall greater cycle, are worth keeping in mind. So they look a lot alike to me. So when I look at it and I look at the 30s, I think there's a lot to be learned about that particular dynamic. I think one shouldn't just believe a cycle is going to follow. I think it's like almost like a life cycle. You know, each person's life cycle is somewhat different, and it's caused by symptoms and conditions that could be measured. So you can look at the economy. You can look at the numbers themselves and see the health indicators. And that's what I did in the books I wrote and so on. So you can look at them directly. You can see how much, like a doctor taking, a CAT scan of the circulatory system. You could see how it's squeezing out. You can see the supply-demand. You can see this dynamic happening. You can see it politically. You can see it globally. So you could see those breakdowns, okay? You have to then put them in the context, I think, of what the process is. What does a country do when it doesn't have enough money? Okay, there are a limited number of things. In order to see that, you can go back in history and get some understanding and also see what's going on now. So I think it's very, very similar to that. Just, to me, these all look like watching the same movie over and over again, except people use different technologies and they have different clothes and so on, and there are different people. But they look so much alike. So I think that this is pretty much looking like the typical process.
So everyone's asking, how does it end, right? Everyone wants to know how the book is going to end, how the movie is going to end. One thing that you've been talking about is how China has been taking over in a significant way, that the economy there has been growing tremendously. I just wonder whether some of the rebalancing and the rejiggering of the trade flows in the world are stymieing that progress, or whether they're a speed bump, or how that you see that fitting into the trajectory that you've been witnessing over the past 10 years.
Well, China has a number of problems that it has to deal with, which I'll touch on. However, since I started to go to China, which is 1984, and I went first for curiosity, and then because it was so interesting and I liked the relationship. Per capita incomes increased by 28 times. Life expectancies increased by 10 years and so on. It's done remarkable. But it now has very significant problems. I'll quickly take you through 4 or 5 of those. On its debt problems, its debts are all denominated in its own currencies and among Chinese, mostly speaking, but it needs a giant debt restructuring. The difficult one is the local governments, because the local governments in China account for more of the economy, and they're broke. The model, they were selling off land, earning money from land sales, and borrowing money to produce high production. And so not only do they have a debt, but they have a model for those local governments that is not an economic model. In other words, what do you do with businesses that don't work, that don't have a profit? And related to this is the rationing system, that they don't have a profit system. They've gone really mostly after quantity. So and the quantity, how do I maximize the quantity of production? Forgetting about the profitability of that. So when you have that, then you have the dynamic that they're now describing, which is now called involution, which is the fact of overproduction doing harm to the economy. That's going to require a big restructuring, like these big restructurings go, similar to what they did in the 90s. Zhu Rongji was the vice premier and premier at the time who did this. But the way they go is you have to pick which companies are going to stay, and which go on the auction block, and which get restructured, and so on. Otherwise, they're going to have the problem similar to China, okay? Because Japan. Japan had the same thing, too much debt, but it was a surplus country, and the debt was in its currency, and they had locals. But you have to do that restructuring. So there's that. And then there's a number of things that we won't have, but certainly the world markets are the change. China produces manufactured goods, is dominant. 32% of the world's manufactured goods come from China. That's more than the United States, Japan, and Germany combined. And now their markets are being closed to them and so on. So they have to go to the third world. There are a number of these types of issues having to do with a pension system, an income tax system, and so on, that if they don't deal with well, and they're very difficult to deal with well, that'll be a burden on China, while at the same time, it's of course doing amazing innovations in a number of ways that are government directed. So I don't want to just say that it has those burdens, and it has a lot of really powerful thinking and quantity of engineers, and what can be done is quite something. They're more advanced in the use of AI for applications than the United States is, for example, actually using AI and so on. Anyway, That's too long of an answer, probably.
Would you rather invest?
That was Bridgewater founder Ray Dalio speaking at the Greenwich Economic Forum. You can continue to watch the full conversation on your Bloomberg terminal. Just type LIVE GO. You can also catch Ray Dalio on the latest episode of Leaders with Francine Lacroix. That airs this Friday at 7 p.m. Eastern on Bloomberg Television and at 8 p.m. on the Bloomberg Originals stream. Quick check on futures, about 5 minutes until the open of trade. We're looking at gains, only 0.1% on the S&P. NASDAQ futures up just about double that, and the Russell gaining as well. Less than 4 minutes now to go until the opening bell. We'll discuss concerns around profit-taking with BNY Wealth's Sinead, Colton, Grant. This is Bloomberg Open Interest. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. Dani Berger is on assignment, and you will see her on that assignment shortly. S&P futures in the green today. We have NASDAQ futures up a little more, 0.2%. Down at the New York Stock Exchange, you've got multiple former Rangers ringing the bell, including Henrik Lundqvist. I was interviewing this guy on the floor of the New York Stock Exchange the day I met my wife. So it's pretty cool for me to see that. Today kicks off their centennial season, 100 years of Rangers at Madison Square Garden. Down at the NASDAQ, you've got Expand, which is an energy play that has certainly expanded. The stock has tripled over the last 5 years, so good reason to smile. Stocks to watch today include Dell. That stock is up 5% right now in the cash trade after it doubled its growth estimates for sales and profit over the next 2 years, citing AI products. Obviously, IBM made an AI agreement with Anthropic's Claude. That family of large language models is going to be used in IBM software for coders. And AMD continues to rise on that OpenAI data deal that really kind of blows my mind. They're going to give 10% of their company to OpenAI so that OpenAI will please buy some of our chips. All right, another AI-driven record high yesterday. Stocks are seeing, well, green arrows, but maybe a little bit of fatigue today with valuations nearing extreme. Citi's Chris Montague says profit-taking risks have rapidly risen across markets and are particularly elevated for NASDAQ, potentially hampering further upside. Joining me at the desk is BNY Wealth Chief Investment Officer Sinead Colton. Grant, Sinead, great to have you here. I wonder what you think of the idea that we're at the sort of profit-taking stage of the AI bubble already. Do we feel like we're that far along?
Well, it's a great question, Matt, and it's one that we talk a lot about with our clients, because the key question is, are we back in the 90s, right? Are we at a stage that's very similar to 99, early 2000? And our view is that no, it is not. And there are a couple of key reasons for that. Really, when you look at the fundamentals, free cash flow margins, they are 11% higher for the tech sector than for the rest of the S&P. So that's extremely attractive. Secondly, on a relative valuation basis, if you go back to the late 90s, the valuations of the tech sector were about 2.4 times the rest of the S&P. Today, that is 1.5 times. And when you think about the tailwind of growth coming through from the sector as a whole, specifically with AI, that still looks pretty attractive. Now, does that mean there won't be any volatility? Of course not. But for us, this is one of the mega trends that you really want to have exposure to.
But how much of this is real? I mean, NVIDIA is going to pay OpenAI $100 billion to buy its chips. Now, AMD is going to decimate itself for OpenAI to buy some of its chips. It just seems so circular. And is OpenAI really that much better than Anthropic or Llama or DeepSeek? I mean, they're all pretty clumsy.
Well, when you look at the adoption levels, there are significant differences based on the different models. And what we've been seeing is that certainly when it comes to DeepSeek, post the initial flurry, when we had the announcement, adoption levels have been much lower than for other models that have been much more prolific, and OpenAI is clearly at the forefront there. But look, this is a regime change. We talk about key mega trends that are going to be important, not just for the next couple of years, but the next several decades. And these are areas that are going to fundamentally change how we do business, how we go to work. We're already seeing an impact in the labor market, we think. So
a negative impact.
Well, it's a really interesting one because there are cyclical and structural forces at work, but certainly when it comes to hiring, the number of entry-level roles significantly lower over the last, call it 6 to 9 months, and we think that's as a result of the productivity gains from AI. You just don't need as many people to conduct those activities.
I want to get your take quickly on the Fed, because you mentioned the job market, and obviously that's why they're giving us these defensive cuts. Do you expect them to continue even as inflation, we think, is on the rise? We won't get the government data.
We're operating on sonar right now, right?
Yeah, exactly.
So look, let's just level set on inflation first of all. Inflation has been hovering in the high 2s, low 3s for quite some time. while it's clearly not at the Fed's goal, that's not a concerning level of inflation. Equity markets can do well, economies can do well. And when you think about the Fed's dual mandate with inflation and the jobs market is clearly under pressure. Now, having said that, we've seen unemployment rate rising to just over 4%, but there's a very significant recalibration that's happening. And that's one of the reasons why it's so concerning that we don't have the labor market data from the government, because what we're seeing are structural forces offsetting cyclical ones. And here's what I mean by that. With demographics, there's clearly less supply of labor. With greater immigration controls, less supply of labor. But then on the other side of the equation, there's less demand as a result of AI and productivity gains. And so taking all of those together, we do think it makes sense. We're seeing a slightly softer labor market. The Fed needs to continue to cut. We're expecting 2 cuts through the end of the year. And let's not forget that while the consumer in aggregate is very healthy, when you start peeling back the layers and looking at even the bottom 90% of the consumer base here in the US, you're seeing increased credit card delinquencies, auto loan delinquencies. So they're really feeling the pinch of higher prices and a slower labor market.
What do you look to, Sinead, to help guide you? What do you use as your sonar here as we don't have the government data? On the job side of the equation, it seems like there's so much more, right? ADP, Challenger, Carlyle put out its indicator today. What do you look at for inflation?
So there's a lot of anecdotal evidence, but when it comes to inflation, we are looking at where are we going to get the biggest bang for our buck, right? One of the largest components of the inflation reading is shelter. That has been in a concerted downward trend, and so that typically has quite a long life to it. So we expect that to continue. Offsetting that, we know that food price inflation is continuing to move a little higher. And so really you're putting together a jigsaw of how are all of these components interacting. But look, as we say, our expectation is we hover around the high 2s, low 3s for the foreseeable future. All
right, great having you in the studio. Thanks so much for joining us. Sinead Colton Grant there, BNY Wealth's Chief Investment Officer. Let's get a quick check on the stock market now. About 7 minutes into the session, we're continuing to look at gains here. This is the move screen, which you probably know by now if you watch this program regularly, is what I think is the most dynamic way to look at the S&P 500. You get a good picture of the breadth here, 3 to 2, so 3 stocks gaining for every 2 that are falling. Right now we're up about 10 points, and if you look at who's adding the most points, NVIDIA puts up 4 of those, AMD adding 2.5, Amazon adding 2, and then you start to move down some of the other companies that are gaining. In terms of the losers, J&J is the biggest loser in terms of point deductions, taking away 1 1/3 points from the index. Tesla is down as well, only 0.5%, but it takes almost 1 full point from the index. Then you see Broadcom, Microsoft, and Eli Lilly bringing up the rear. In terms of the industry groups that we're looking at today, it's a pretty even split here. Financials, tech, and utilities are leading the gains. The losers are healthcare, consumer staples, real estate, energy, consumer discretionary. So some of these are defensive. Coming up, we head back to Citadel's Future of Global Markets conference. That's where my co-anchor is on assignment right now. Dani Berger sits down with former World Bank President David Malpass. This is Bloomberg Open Interest. Time now for our top calls, some of the analyst action to focus on this morning. First up, AMD getting upgraded to a buy at Jefferies. Jefferies raising its price target to a street high of $300 a share following the deal with OpenAI. The analyst says the partnership is a validation of AMD's AI roadmap and highlights the strong demand for the technology. AMD stock has been on a tear this year. You can see up 80%. Next up, Fifth Third Bank is getting raised to a buy at Morgan Stanley following news it would buy Comerica. The analyst says the acquisition is a good strategic fit for Fifth Third, and you can see those shares up 0.8% this morning. And finally, Evercore ISI is downgrading home builder stocks, including DR Horton. The analyst says the sector rallied this summer in anticipation of falling mortgage rates that could power a rebound in housing demand, but that just hasn't happened yet. DR Horton shares falling more than 3% as a result. Billionaire Ken Griffin is warning about the rush to gold. The Citadel CEO says the all-time highs for gold is a concern for the U.S. dollar. He spoke at Citadel's Future of Global Markets conference here in New York City.
As you see sovereigns around the world, as you see central banks around the world, as you see individual investors around the world go, you know what? I now view gold as a safe harbor asset in a way that the dollar used to be viewed. That's what's really concerning to me.
My co-host Dani Berger is at the Citadel conference. She joins us now with former president of the World Bank, David Malpass. Dani?
Matt, thank you so much. And that is indeed correct. I am here with David Malpass. David, thank you so much for joining this morning. Wonderful to see you.
Thank you, Dani. Nice to see you.
So for some time this year, you've really been arguing that this is central bank policy and a Fed that needs to be proactive, that needs to cut and turn to a more pro-growth policy. We did get a cut from the Fed last month. The dots indicated we'd get 2 more. Are you more comfortable now with the Fed's posture?
I'm happy they cut. I think they should have cut in June, but it's very important how they communicate and think about why they're able to cut. I think we need to shift the models a lot to where the Federal Reserve recognizes that production in the economy is going to be a key factor in inflation. Right now, they look backward at the inflation rate, and that's been problematic, so then they wait and wait and wait. So that's made them too late. This is not a new problem. This is a problem that the Fed's had for a long time if you look at the inflation rate, then you miss what's going on in the economy. I think also they have to say something about the dollar, that the dollar is really important. And if you think about the way prices are set, you need to have the purchasing power of the dollar actually support price stability within the economy. And that hasn't been occurring.
And I know you've said previously that a strong dollar, the strength and continuity of the dollar should be an important goal for the Fed. Is there a concern, though, if they are cutting much more, especially as Europe stops cutting, that you get a material weakness in the dollar, and that acts against the very goal that you're trying to accomplish?
I actually argue for a stable dollar, not a strong dollar, because that's going to really affect competitiveness. The U.S. is trying to, and President Trump has a policy of bringing manufacturing to the U.S. So you don't want a strong dollar, but you do want it to be stable in purchasing power so that you don't have an inflation problem. And I think that's what's missing in the Fed's current thinking and statements about it. The upside, there's a huge upside. If you say that you're going to maintain the purchasing power of the dollar or defend the dollar, then you can have the whole yield curve be lower. That's the short end and the long end, which, again, we're not achieving so far. In the Biden administration, the Fed cut rates and the yields went up because no one explained or said to the government, you've got to spend less money and you've got to really got to have stronger investment in the U.S. They were regulating it so harshly that people didn't want to invest. So we have a conducive environment now. It's quite possible for the Fed to shift to a model where they're more welcoming of growth that would allow faster growth without them leaning against it. That's what we have to avoid right now.
And David, again, some very clear ideas here. Have you had any conversations with this government, with Scott Bessent, about maybe being on the Fed next year?
I was very happy with Secretary Bessent's article in the Wall Street Journal and in the magazine International Economy, where he laid out some of the reform challenges for the Fed. And so I think that's going to be really important in where the world goes. Can you get a U.S. Federal Reserve that leads the world toward more stability? And that gives you lower interest rates for the countries that are doing well. well. It's going to be a bit of a competition among countries to see who's got better regulatory policies, better energy policies, better legislation on stable coins, which the U.S. is right now leading on.
So,
That's
David,
really
if you were
important.
called to help lead this reform, would the answer be yes? Would you join the Fed if asked?
I was honored to serve and would be, and always am. What I want to see is the U.S. do really well with this economic plan, and I think that can lift the whole world, too. I really think there is positive opportunities that people are, not talking enough about right now.
Are you concerned, then, with all of this going on, the fact we just heard from the Citadel founder, Ken Griffin, about gold being at a new high, Bitcoin is at a new high. Are you concerned that these other pockets are gaining in terms of either havens, or as people turn away from global currencies and sovereign debt? Is that an issue right now?
It's an issue because they're moving and they're momentum-based markets. I think the good news is there's not that much capital being diverted into them yet, so it's not a matter of them draining resources. It's a matter, are they signaling indifference to the dollar? And by central banks in general, are they indifferent to the value of their currencies? In that case, people go into a safe haven, as you're calling it, or a debasement trade. I don't think that's. It's not fatalism at all. In that the U.S. has full range of choice to say that the dollar is the best currency in the world. It can be defended. It doesn't take higher interest rates to defend it. It takes the statement that you care, that you respect the dollar, and that can be done pretty easily and recover some of that that instability that we have right now.
Are you concerned that a prolonged government shutdown, for example, we're in day 7, I believe, of a government shutdown, could exacerbate or ignite instability?
No, not on the government shutdown. I've been in and out of government, and I don't think that's such a problem. It's very important to have an efficient government in the U.S., but it can be much smaller, and so that's part of what's going on right now, a fight over how much waste are you going to tolerate, and that's a political issue. So that's not so much the issue to me. Very important is energy, and how do you form leadership on that in actual production? How do you get through the permitting process, the regulatory process on nuclear power, on natural gas? Each of these, the concrete things that countries do to enable growth are going to be very important right now. People talk about the world order. They somehow have this romantic notion that it was being done well before. It wasn't. It was really failing. And so now there's the opportunity to set up a system that works for the United States and I think works for other countries. But it's going to be new trade policies, new central bank policies, and new energy policies. That's all got to be put together quickly.
All right, well, we'll have to leave it on that note. I know you also have a panel to get to, so we will let you go. David, thank you so much for joining this morning. And Matt, that was, of course, David Malpass, the former president of the World Bank, on changes that he needs to see, whether it be energy reform or reform to the central bank.
Yeah, absolutely. With a wealth of experience that not many people can match. Dani Burger speaking with David Malpass. She'll be back in the next hour with David Marcus, the CEO of LightSpark. We'll bring you that interview. Coming up on this program, though, it's not just OpenAI deals moving stocks. Even the public mention of a company by OpenAI executives can send shares higher. That's next. This is Bloomberg Open Interest.
We see there are multiples of demand that are latent and untapped from what we have today. And even today, obviously, by any standard, demand and revenue growth has been torrid in its pace. And so really, we have to invest ahead of that. And I think that's going to be the rate limiter for us to be able to go capture demand, whether it's consumer or enterprise.
OpenAI COO Brad Lightcap telling Bloomberg about his company's surge in demand. OpenAI has become the stock market kingmaker with its recent deals. Even the mention of companies by OpenAI executives can send the stock spiking, as you see here. Bloomberg Tech's Caroline Hyde joins me now. And Caroline, we have companies decimating themselves to get in business with OpenAI, right? I mean, AMD is giving a 10% stake in themselves to convince OpenAI to buy their chips.
And then we were thinking that compute demand was limitless. And yet we're still seeing all these sweetened deals where companies are sort of giving OpenAI an edge because they get in return a massive increase in their own market capitalization. You've seen it with Oracle, you've seen it with AMD, but it's not just AI infrastructure deals. It's just about putting your company's very bread and butter within ChatGPT. ChatGPT is becoming a super app. They don't want you to leave. But what can you do is you can use FigJam, so Figma's software, to help build the latest application you're doing within ChatGPT. You want to go on a road trip, you can use Spotify to build your playlist. But Spotify is integrating within ChatGPT. Both these stocks rally hard. Figma was up at 1.16% on the back of this. Expedia, we were all worried about how travel companies were going to be decimated by ChatGPT, but ChatGPT is kind of giving them a lifeline, saying, come on in, we'll fold you in, we'll be a partner. Expedia goes up and to the right yesterday. We see spikes in Mattel because you can use Sora 2 to develop your next toy. Is this huge productivity gains, Mattel, or is this just Mattel being name-checked and Mattel stock riding? It's got this meme vibe to it, but is this momentum? Is this real material productivity gains? Is it madness?
That's a good question. Harvard and Stanford did a study and found that for a lot of employees, they're using AI to create work slop, which isn't really moving the ball forward. I'm guilty of this. I sit on ChatGPT all morning long, and I could easily accomplish the same task in half the time if I didn't use it.
But the fact that you're integrating it into your workflow might give the productivity gains aplenty in a year or so. Many that will come back. When you cite the MIT report, when you worry about 95% of all these pilots not working, most will say it just takes time, it takes integration. The transformative effect of the internet didn't happen overnight. It took years, it took decades. But there are companies that will win, there are companies that will lose, and we're still at the very first innings. If you're going to be bullish about all of this, I can also see the cynicism in some of the way in which these deals and the money flows are going.
Looks circular. All right, Caroline Hyde, we look forward to your program, Bloomberg Tech, at 11 a.m. She will be talking to the CEO of CoreWeave at 11. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller. Dani Berger is on assignment. She's at Citadel's Future of Global Markets Conference, and she will join us again later this hour. Coming up, signs of fatigue. The AI-driven rally is hitting extremes, with Citi warning investors may soon start cashing in. Citadel billionaire Ken Griffin sounds the alarm, warning the U.S. economy is on a sugar high and calling the rush to gold really concerning. Plus, Tesla plans to unveil a cheaper version of its cheapest model, the Model Y, today, trimming features and premium materials to offset the loss of U.S. incentives for electric vehicles. Let's kick it off with a look at stocks. On an 8-day winning streak, I asked Sinead, Colton, Grant of BNY Wealth earlier if we are at the profit-taking stage of the AI bubble.
The key question is, are we back in the 90s, right? Are we at a stage that's very similar to 99, early 2000? And our view is that no, it is not. When you look at the fundamentals, free cash flow margins, they are 11% higher for the tech sector than for the rest of the S&P. So that's extremely attractive. Secondly, on a relative valuation basis, if you go back to the late 90s, the valuations of the tech sector were about 2.4 times the rest of the S&P. Today, that is 1.5 times.
Let's continue the conversation with Lizanne Sonders, Charles Schwab, Chief Investment Strategist. Lizanne, great to have you on the program.
Thanks, Matt.
Are we at the stage where we can say, okay, this is an AI bubble, and let's try and measure how far along we are in that bubble?
Perhaps not quite yet. I think we're at not so much a profit-taking stage, but a rotational stage. When you look at the fact that of the Magnificent Seven, only 4 of the 7 are outperforming the S&P 500. They're not ranked high from a performance perspective. They are from a contribution perspective, at least the 4 stocks that are outperforming the S&P. But in the case of the NASDAQ, the best performing Mag 7, which is NVIDIA, is not even in the top 500 best performing stocks. What I do worry a little bit about is some of that rotation is going into lower quality, very highly speculative areas of the market. So baskets like the meme stocks or non-profitable tech, the quantum basket, and these are all Goldman Sachs tickered baskets. drone basket. So I do worry about a little bit of speculative froth down the quality spectrum, but I think this is more about rotation as opposed to across-the-board profit taking.
So what do you need to see, or what do you think retail investors are waiting to see before they start to sell and get out of this? I mean, 8 days in a row of gains. We've had, I don't know, 35 35 record highs this year. It's just been an incredible run up after 2 years of 25% gains each.
Well, I would tell you, though, that I think it depends on what cohort you're talking about. I think the retail trader, the shorter-term retail trader, they tend to put blinders on, actually, to macro conditions and even fundamentals to some degree, and tend to have more of that buy the dip, FOMO, chasing kind of mantra. I think institutions are positioned a little bit more cautiously, and that's where some of the medium-term to longer-term rotations are starting to occur, driven by some valuation-related concerns. So in terms of what could tip this thing, sometimes it's just price action that causes a shift on the part of the cohort, which has become so powerful as a market driver. Again, that retail trader estimates are that they represent somewhere between 20 and 25% of trading volume. I just think in terms of what might be triggers for more sustained profit taking, it's a little bit of a different story if you're talking about retail traders versus maybe more of those traditional institutions.
Well, we're all wearing blinders now when it comes to macroeconomic data because of the government shutdown. How does that affect the market?
Well, you've certainly seen volatility come down, especially in the Treasury market. So the MOVE index is now down at a 4-year low. So I think that's one way it's reflected. Also, much greater reliance and more research being done on alternative sources. Bloomberg is obviously a great source of a lot of data, absent government-issued data. But if you look on the employment side of things, you've got Revelio, you've got ADP, you've got the data that came out from Citadel today, Challenger. So there is access to labor market data on the pricing side, absent the traditional inflation data, which of course the BLS also releases CPI and PPI. The regional Fed data is pretty good on a lot of the inflation metrics, the ISM data. So I think there are other sources, and they're becoming elevated in terms of importance in the absence of that government data. But I think the overarching impact has been on just a lower level of day-to-day volatility.
Do you expect the Fed to continue cutting at the same rate, 25 basis points, the next few meetings, even without this data, just to be, I guess, defensive for the labor market's sake?
Well, unless the Fed opts to go against market-based expectations, which they don't tend to do, it looks like the October meeting is a lock for a cut. But if this was an elongated shutdown, and in particular, if some of the non-government sector data releases point in a direction that is a bit more difficult for the Fed, meaning upward pressure on inflation, absent any meaningful weakness in the labor market, then I don't think it's a layup that the Fed continues to cut here. So it wouldn't surprise me if the October cut is the final one for this year. But once the government opens back up, and on that subject, by the way, given that the Fed is very focused on labor market data, we have to remember that once the government opens back up and we get the September jobs report, that's pretty clean data because the reference period goes through about September 12th. The problem will be the October jobs report, especially if the government stays shut down through the end of this week, because then you've got a big chunk of the reference period within the October jobs report that is less clean data by virtue of the shutdown.
How much does the shutdown matter? Because it's October 7th, right? In 3 more days. You have a large swath of federal employees who are supposed to get paychecks and won't. President Trump is threatening not to give them back pay. Is that a big problem for the U.S. consumer?
Well, it's a big problem for that U.S. Consumer. In the aggregate, if you add up all federal workers, it's not a large percentage of the total workforce, but there's ripple effects, of course, inclusive of ripple effects through the confidence channels. To your point, state level weakness that might crop up in things like, retail sales, whether you're talking about California, which as a state employs more federal workers than any other state, then you go into the DC area state. So I think you'll see it at the state level, probably a little bit less of an impact at the broad national level. That said, where we are starting to see an impact, some demand destruction in consumption, leaving aside the government shutdown, is tariff impacted areas. So when you look at a lot of the weekly sales data that we can actually get from Bloomberg, where you're seeing the demand destruction is in areas that have been tariff impacted. So clothing and furnishings and appliances and sporting goods. So that's another area to remain focused on, absent government data, is a lot of that credit card, debit card based transactions, to see where there are still pockets of strength, but where we might start to see some weakness.
All right, Lizanne, great to get some time with you. Really appreciate it. Lizanne Sonders,
thank you,
there of Charles Schwab. Let's get a check on what the markets are doing right now. It is, as I said, the 8th consecutive day of gains, but you can see those gains are quite thin. The S&P 500 up just 0.06% at 67.44. The NASDAQ gaining a little bit more as the tech stocks get a lift. Let's take a look at some of the single stocks moving at this hour. Dell is one of them. It's updated its long-term outlook, doubling its growth estimate for sales and profit in the next 2 years, citing demand for AI products. IBM is another one. Big Blue says it has a deal with Anthropic's Claude. It will use those large language models in its own software portfolio. And as a result, IBM up almost 3% in today's trade. And AMD still riding high off the announcement of its deal with OpenAI. The move sent its shares surging 24% yesterday, adding more than $63 billion to the company's market value. And you can see today it's up another 5%. Up next, analyst Joseph Moore of Morgan Stanley joins us to discuss his outlook for the chip sector as he upgrades Micron. And happening right now at the Greenwich Economic Forum, Lisa Abramowitz is talking crypto investing with the CEO of Calamos Investments. You can catch the full coverage there. You can watch the conversation live on your terminal. Just type LIVE GO on the Bloomberg. This is Open Interest. Let's get to high interest now. Look at what's making headlines around the world. The White House is considering not paying federal employees for days they have been furloughed during the shutdown. It's a move that could run afoul of a law that President Trump himself signed in 2019, mandating that workers get back pay once the government reopens. The president said he was open to negotiating with Democrats over health care subsidies to bring an end to the funding standoff yesterday, but hours later he reversed that position. The CFA Level 1 pass rate slipped to 43% in August. That's a notch below May's results, but still above the decade average. More than 26,000 candidates took the test, which demands hundreds of study hours. Meanwhile, AI models are blitzing through the toughest Level 3 exam in minutes, underscoring how machines are gaining ground in finance. And JPMorgan Chase Vice Chair Peter Scheer, a key lieutenant to CEO Jamie Dimon and the architect of the bank's influence in Washington, will retire next year after nearly 2 decades at the firm. Scheer will step back in the spring and remain a senior advisor through 2026. He joined JPMorgan in 2008 and led major initiatives from Detroit's revival to the bank's healthcare venture. Dimon credited him with helping the firm navigate some of the most complex events of our time. Let's turn now to the chip makers. Morgan Stanley has upgraded Micron to a buy with a $220 price target, saying the company is headed for multiple quarters of double-digit price increases. Joining us now is the analyst behind that call, Joseph Moore, Morgan Stanley senior semiconductor analyst. Joseph, thanks so much for joining us. You know, whether or not this is a bubble, whether or not the financing is circular, I guess at least for the next few years, people like Micron are still going to get paid, right?
I think that's right. I think, the question of a lot of these circular deals that you're referencing, importantly, don't really kick in until the second half of 2026, right? So we have a situation where there's very strong expectations for AI for the next 12 months. And then there's a bunch of stuff happening that would cause it to inflect to a more positive growth rate in 12 months. I'm not necessarily endorsing every aspect of that, but it is all upside to what's in street models. And so I think it is very strong conditions. And I think the strength that we're seeing right now in commodities, which is not just AI, I would sort of argue that the legacy parts of the business are actually where we're seeing more strength. But it's a way of kind of playing some of this strength in compute without kind of making a bet on custom silicon versus NVIDIA versus AMD. It's a beneficiary of the broader base trends. And the stock's moved up a lot. It was a late call from us. We've said that. But the conditions that we're seeing are really positive and have the potential to drive significant upward revision to earnings. And the stock's pretty inexpensive on those near-term earnings. So it's a stock that we like quite a bit here in the near term, even though we missed the early stages of the move.
We've been talking a lot about a bubble, and I don't think it's fair to, certainly not for me to characterize this as a bubble, but a conclusion hasn't been drawn obviously yet, and they normally aren't until it's burst. But Minsky has said there are stages, I think displacement, then boom, euphoria, profit taking, and then panic. That's the end, obviously. If we're in a bubble, Joseph, where do you think we are?
Well, look, I think we've seen cloud growing a lot for 20 years, and we've seen about 5 windows of digestion. So it's certainly possible that the truth is in the middle, that we're looking at a very strong investment cycle, and that there will be periods of consolidation where we've moved ahead. I think there's very strong visibility for the next 12 months for everything in AI. I think the near-term dynamic that I think is sort of exciting for the Microns of the world is that we've spent a lot of time and energy bringing these AI servers up and running, and now we're finding that a lot of the hardware that sits alongside of those servers is actually where the supply chain pain points are. So traditional servers, CPUs, storage, those are the areas that are causing the most angst. But I think there's a very strong 12-month window ahead of us. And then you shift to these new agreements that are being signed, and those are all starting second half 26 with NVIDIA's Rubin or AMD's MI450 or Broadcom's ASIC platforms. All of those businesses start in the second half of 2026. And we've actually got the market kind of going through a little bit of a plateau at that phase. So all of the stuff that we're worried about, is this excessive? Is the circular financing creating, too much expectation? Those are all very reasonable questions, but that's upside to the trajectory that we're on, I think. And so I think right now, a lot of the investing in 2025 for AI is actually managing the high token growth and the query volume, right? So it's the inference part of the business. It's the actual usage of these models that's driving a lot of the investment. So I certainly would take your point. I think there are periods of consolidation that will come. And I think if you were to take every positive thing that's being talked about and put it in your 5-year model, you could sort of say that there's signs of excess inflation there. But that's not really what people are banking on over the next couple of years. So Still a very positive outlook for me.
Well, I mean, is production capacity a constraint for a company like Micron? I mean, for any of these chip makers, is it the case that they just can't make as many as they could sell for years to come?
Yeah, I think so. My spreadsheet answer to that, the reason that we've been too cautious for the last couple of months is that, look, there's a lot of capital going into the DRAM space. There's a lot of investment happening that should generate supply growth. You look at where we are with the PC market, with the smartphone market, you would sort of say, okay, we don't have an oversupplied market, but we don't have a shortage environment either. I think the reality that's playing out right now is that we are experiencing significant shortages. And it feels to me like pretty early stage, people are not able to get everything that they need, not able to deploy everything that they need because there's just not enough DRAM. And this is not really an AI comment. It's much more on, traditional DDR5 for servers and things like that. But we're seeing levels of anxiety from the supply chain that are worried about all of 2026. Are we going to be able to get everything that we need? And it's very reminiscent to me of 2018, where the cloud guys kind of first emerged on the scene and there was all this incremental demand for DRAM and we saw these shortages. So I'm kind of reporting on strength that we're hearing rather than kind of analyzing and coming up with that. But it feels very durable. It feels like the people who are purchasing managers believe that this is going to be strong through all of 2026, and they're behaving accordingly. People are going to be willing to build inventory because they believe that prices are going to keep rising. So it seems like it's good, at least for 2026. Longer term, to me, I would say the longer term through cycle metrics, Micron looks expensive. So the stock is interesting insofar as I see very strong near-term dynamics. Not really making the case that it's years to come. But again, these more bullish cases for what AI looks like, well then we're sold out for many, many years. But
does
Micron been a little bit more measured.
Does Micron have an edge on its competition? I mean, I started covering this company 25 years ago, and back then people were saying DRAM is a commodity. Is high bandwidth DRAM somehow special?
It's a little bit special, but it's still, I treat this as a commodity company for sure. But a commodity company in a consolidating space that has had very good, dynamics, still cyclical. And it's important to have that cyclicality in mind. High bandwidth memory is very difficult to do. Micron is not the leader Hynix is, but Micron is in kind of low 20% market share.
Right.
And we think they have very good product quality. They have performance per watt advantages versus the competition. So it's not, I would say that they have a huge edge, but I would say that it is a market that feels like it has durable structural margin profile.
Got it.
That's a little less commodity-like.
Got it.
And it's helping the more commodity part of the market because it's siphoning away supply.
All right, Joseph, great to get some time with you. Really appreciate it. Joseph Moore there at Morgan Stanley. Still ahead, Ken Griffin said the U.S. economy is on a sugar high. His comments next. This is Bloomberg Open Interest. Citadel CEO Ken Griffin says fiscal and monetary policies have created a sugar high that masks underlying risk. He spoke with Bloomberg's Francine Lacroix at Citadel's Future of Global Markets conference right here in New York City.
The markets are seeing the enthusiasm that the Trump administration has created in the American investing public and in corporate America. I mean, we'll get into some policy details in a few minutes, but it's important to understand that this administration is clearly trying to encourage economic growth in the United States. They are pursuing a set of policies to reindustrialize America, and they are unquestionably interested in America's prosperity in a way that we have rarely seen from an administration in years past. Secondly, the Trump administration is very much aligned with seeing the success of the American worker. So a number of the policies that are being effectuated really are about the average American family feeling that life is better and working better for them. This backdrop is fueling much of the enthusiasm that we see in markets in the United States. And then, of course, we're on a program of both fiscal and monetary stimulus that you would expect to see in the middle of a recession. We're seeing right here, right now, in a period of near full employment several years into the business cycle. So we're definitely on a bit of a sugar high in the U.S. economy right now.
So broadly, have markets moved away from the tariff issues?
The tariff issue is pretty much in the rearview mirror right now from the perspective of the market day in, day out. Now, the issues that relate to tariffs, in particular high inflation, are yet to be resolved. There's a sense of almost inevitability that the inflation genie is going to go back in the bottle. But I think that's a very premature conclusion.
That was Citadel CEO Ken Griffin speaking with Bloomberg on his outlook for the U.S. economy. Up next, we hear from David Marcus, the CEO of LightSpark. This is Bloomberg Open Interest.
Good news is there's not that much capital being diverted into them yet, so it's not a matter of them draining resources. It's a matter, are they signaling indifference to the dollar? Central banks in general, are they indifferent to the value of their currencies? In that case, people go into a safe haven, as you're calling it, or a debasement trade.
Now, as former president of the World Bank, David Malpass, speaking at Citadel's Future of Global Markets conference in downtown Manhattan. My co-host Dani Berger is there and joins us now with the CEO of LightSpark. Dani?
Matt, thank you so much. That's right. I am here with the CEO of LightSpark, and that is David Marcus. David, thank you so much for joining. Wonderful to see you. And look, the goal of LightSpark is a really ambitious one. Create a global payment method that's as easy as, Zelle or Venmo here in the United States. You've said before that you might spend your entire life working on this. You are a serial tech entrepreneur. Do you think it will take a lifetime? How close do you think we are to widespread adoption of the technology behind LightSpark?
Well, hopefully it won't take a lifetime, but if it takes a lifetime, I'll do whatever it takes. I think, look, we're in 2025 where you can talk to an AI agent and ask it about anything you'd want, and still we're moving money like it was 1974. And it's not really the case domestically. So you said, Zelle, Venmo, and, we have solutions to move money between people in the same country. But if you were to send money to the UK right now, or to Europe, or to Mexico, or to Brazil, it would take a couple of days at best, and it won't work on weekends or after hours, and it would cost you $50. And that's kind of ridiculous in 2025. And so what we're trying to do is really change that and enable money to flow on the internet like any other type of content.
Why has it been so difficult? To your point, this is something that people have wanted and have tried to chip away at. And we're in 2025, and still we're not there. What is the roadblock?
Well, I tried once before when I was at Meta with the Libra/DM project. And the reason it failed is it was too centralized. And if it's too centralized, then you're trying to change the way that money moves around the world on a more centralized platform. No matter how hard you try to decentralize it, you're going to fail. And the conviction that we've built through this experience is that if you want to really create an open internet for money, you have to build it on top of something that is truly neutral and decentralized. And the only thing that meets the bar, in our opinion, is Bitcoin. And that's what LightSpark does, is build core technologies and products to enable domestic real-time payment systems to use Bitcoin as a neutral settlement network. So you can send $1 from your US bank account to someone in Mexico receiving Mexican peso 3 seconds later, any day of the week, 24/7, at a much lower cost than all of the next alternatives. So that's what we're doing.
You've also said in the past, though, that part of the reason that the effort you led at Meta with Libra didn't work is because just regulators also put up a lot of roadblocks. I think the quote you said in the past was it was 100% a political kill.
Yes.
Do you think if you were working on it today during the Trump administration, things would have been different?
Well, maybe, but I think the bottom line is, when we announced Libra, a week later or 2 weeks later, I was testifying in front of Congress. You can't call Satoshi Nakamoto to testify in front of Congress. And the point is, if you're actually putting so much power in the hands of a consortium or a foundation or someone leading this thing, is identifiable, then you have a problem. And so you want to build on top of something that really looks and behaves just like the internet. And for money, this is Bitcoin. Bitcoin is the internet of money. We just need to build the technologies and capabilities to enable it to move the money where it starts and where it ends.
Have you had these conversations with the Trump administration, with regulators? Are you encouraged by the direction they're moving in?
Yeah, I think it's definitely better now than it was. And, that's a pretty low bar given what the previous administration tried to do in terms of putting roadblocks in front of the entire industry. But I think, we're building on top of Bitcoin, and now you have all of these ETFs and all of these large financial institutions that are supporting and embracing Bitcoin. And so I think, the horse has left the barn. There's just no way that we're going to change that. And Bitcoin is the most accepted and trusted digital asset in the world right now. And that's where
Speaking of which, LightSpark does have its own Bitcoin investment that you bought when there was a nadir in the cryptocurrency about 3 years ago. You're probably feeling excellent about that. What do you make of this most recent run-up? Have you been buying more for the company? Does it have further room to run?
Well, we bought Bitcoin because we're in need of Bitcoin liquidity to facilitate transactions on the Lightning Network and now on Spark, our new Bitcoin Layer 2 that facilitates real-time transactions and supports stablecoins on top of Bitcoin. And so we were lucky enough that when we started, we were in a bear market, and now we're not anymore. which is kind of an unusual place to be for a startup, but a nice place to be. The run-up is basically a factor of many things. I think, I still feel Bitcoin is severely undervalued, especially if you compare it to gold. Like if Bitcoin was worth as much as gold, it would be $1.3 million a Bitcoin. And I think it's just a matter of time. And I also feel like the utility phase of Bitcoin as a neutral settlement network and asset for all of the payments in the world hasn't been priced in at all. So I think it's just still so incredibly early for the asset and the network.
David, before I let you go, I do want to touch on, I mentioned you are, by any stretch of the imagination, a serial entrepreneur. You started a company, you sold to eBay. We talked about you working for Meta, for PayPal. At the moment for tech entrepreneurs, it's all about AI. More than 50% of VC money is flowing into AI-backed companies, and they are going at pretty punchy valuations. Is there a concern that things maybe have gone too far and might create an issue down the road, especially for a lot of these tech entrepreneurs?
Well, I think, the value that AI can create in terms of the compounding progress that it generates for humanity and society and the economy, I think is unprecedented. So I think it's really hard for us in 2025 to judge where we're going to be 10 years from now, because humans are really bad at understanding compounding, and especially compounding of progress that we've never seen before at this rate. So I don't know. I think, certainly not everything that people are investing in right now is going to pan out. But I think when you look at the core models, the core chip manufacturers, and all of the ecosystem that is built around it, energy, all of these things are probably still underestimated in terms of upside potential.
So not a bubble.
No, I mean, I think there's bubble on the periphery, but not at the core of the AI promise.
Yeah, it's fair. Our tiny little human brains have a hard time comprehending exactly where we go from here. David, thank you so much for joining. Really wonderful to speak with you this morning. Matt, of course, that is David Marcus, the CEO of LightSpark.
All right, fascinating stuff, Dani. Dani Berger there speaking with David Marcus from LightSpark. He's going to resolve the challenge that's been facing those of us who've lived and worked internationally forever, which is that it's very slow to move money and expensive. Later today, catch Dani's interview with Mark Lasry, the CEO of Avenue Capital. That's one you don't want to miss. That comes on when Romaine and Katie host The Close at 3 p.m. New York time. Definitely tune in for that. Let's get a check on what's going on in the markets right now. We've been open for an hour and 7 minutes, and we are now looking at a loss on the S&P 500, down 0.1%. Of course, that can change. There are still 5.5 hours to go in this trading session. Let's get a look at some of the single stocks on the move right now. Constellation Brands reported better than expected second quarter results, citing robust beer and wine sales. The company's beer division, which owns Corona and Modelo, is outperforming the industry. Intercontinental Exchange, the owner of the New York Stock Exchange, plans to invest as much as $2 billion in cash in Polymarket. That's the betting platform. The transaction values Polymarket at roughly $8 billion in total. And Tesla plans to unveil a more affordable version of its most affordable model, the Model Y, today. This one, the new one, will lack certain features and use cheaper materials. That's kind of a bummer. For more on Tesla, we're joined by Bloomberg Global Autos editor Craig Trudell. And Craig, the big promise of Tesla from the get-go has been that they will release an electric vehicle that's affordable for the masses. And to some extent, the Model Y already is that. You can get into one for lower than the average cost of a new car in America. But do they need an even less good version for a less expensive price?
I think after the expiration of the $7,500 tax credit, the answer we're going to find out is going to be yes. And, the Model 3 also, it can be had for less than the average price of a new U.S. vehicle. And yet, we've seen a lot of pressure on EV demand, and I think only more to come in that regard, with the fact that we now no longer have a little bit of help from Uncle Sam. And so there's a lot of discussion, I think, that will sort of continue in the weeks to come about just how much of a cliff we're going to see with that federal tax credit going away and what can be done to mitigate it. We've already seen some manufacturers, come out with discounts where they're essentially going to be footing the bill for the fact that the tax credit is going away. How long can they afford that? And will we see more where this comes from in terms of other manufacturers maybe decontenting some of their EVs to try and offset the fact that we now will see EVs get incrementally more expensive for the typical buyer?
I can imagine that not everything is necessary that comes in the Model Y or Model 3 today, so I guess that makes sense. But are there manufacturers working on it from the ground up? I know that in Europe, at least, because of new regulations, I just saw this Dacia Hipster, which is like a tiny little cube, smaller than a Mini, but only costs 15,000 pounds or something like that. Are there going to be American car makers that give us those kinds of products?
I think you're seeing a lot more competition in this lower price, these lower price segments for electric vehicles in Europe, in part because we're seeing so much Chinese competition, and that is not something that we're seeing in the U.S. market. This was something that we saw the Biden administration really kind of put the wall up in terms of Chinese car imports, and the Trump administration has kept that in place. And maybe some indications from Donald Trump himself, actually, that he would be open to changing that if Chinese manufacturers were to build in the U.S. And yet, I think the Chinese companies that make and sell affordable EVs, I imagine, would be pretty reluctant to sort of take him at his word, given just how much sort of xenophobia we hear in Washington. I think about when Ford did a deal with CATL. To sort of license some of their battery technology, we saw such heated rhetoric about this notion that this was a Trojan horse for China. And so, just how much competition, I think, is part of what dictates the fact that we haven't really seen a whole lot of affordable electric vehicles in the U.S. market.
Well, I mean, so many things are coming together to make them more expensive, right? They can't get the rare earths here. The Trump administration just did another deal to try and crack that egg. They have real problems with affordability of aluminum because of the tariffs on aluminum and steel. And you just bring up Ford, and I wonder what you think of the fact that a big aluminum plant here in New York caught fire that Ford really relies on, and that could, at least according to the Wall Street Journal, stop work on the F-150. How much of a problem is that?
I think it remains to be seen just how material it is. I think, this was announced a few weeks back, and the fact that we haven't seen Ford put out an 8K about the level of disruption there sort of makes me wonder just how much they're able to sort of mitigate for this somewhat and use alternative suppliers. But this is no doubt, a significant deal, particularly for Ford, because with the F-Series, they went to these aluminum bodies years ago, and that was such a major sort of watershed moment for the materials industry, where we've seen steels sort of dominate in this regard, and we haven't seen a whole lot of following from Ford's competitors. So perhaps this will sort of add to reasons why others will be reluctant to switch given this risk.
All right, Craig Trudell there talking us through a number of the issues in the automotive sector. Is Dacia, am I pronouncing that right? Dacia, it's like Romanian, right?
Dacia, I think, yes.
Dacia, okay, the Dacia Hipster. If those of you watching us who haven't heard of it, just Google it. I swear it's going to be interesting. The Dacia Hipster. Craig Trudell runs our global autos coverage for us. Thanks very much for your time. Coming up, Trilogy. We were just talking about that. Metals soars as the U.S. takes a 10% stake in the Canadian minerals explorer. More on that next. This is Bloomberg Open Interest. President Trump says the U.S. is going to take a 10% stake in Trilogy Metals, a Canadian mining firm. That brings the list of companies that the U.S. has taken a stake in since Trump returned to office to 5. Intel, Lithium Americas, MP Materials, and U.S. Steel are the others. Joining me here at the desk is Joe Doe, Bloomberg economic statecraft reporter. And this is such a fascinating, I mean, once again, it's a tiny little company, right?
Yeah.
It's not an Intel-sized investment, but it really brings up the argument again, is this like central control a la Beijing, or is this, the U.S. preparing for war?
Ooh, the second half of that question is interesting. And I think it's interesting because I do believe on some level the Trump administration is looking at this through the lens of like wartime powers. And I am still not sure if this is the right approach or the wrong approach. I've talked to many people who are investors in the space who've been on the fence, right? They've said, listen, there is a serious national security concern. If we're hearing prime contractors and aerospace companies and others in the market say to you, the gallium, germanium, and antimony export controls and permanent magnet controls that China has put on are causing serious squeezes and serious concerns within the halls of the Department of Defense or War and other parts of government, then you do have to stop and seriously consider, well, how do we actually find out a way to get those materials? This is what the administration has laid out as a blueprint as to what they think is the way to begin a mine-to-magnet domestic supply chain. The further question is, are these the right investments?
Right. Or is this what you necessarily need? Do we need to have a 10% stake? Isn't it okay if we just open up the road? Apparently there's a road from a remote mining town to these resources in Alaska, 211 miles long, that Donald Trump says Biden disallowed, and now he's going to open.
So last week, we wrote a scoop that the administration has been actively speaking to market participants, specifically mining companies, that they were seeking warrants in companies as part of potential deals, right? Offtake agreements. If you can bring your processing to the United States, onshore it. If you can't, because it's a mine, we understand that. But the big thing was the warrants. And I think to your question about, like, why not just give them the money to build the road? At the core of this is an administration that thinks we're no longer just giving out money the way that the government has typically done, right? We saw this in every administration, right? Especially during the Biden administration in the form of grants or whatever. And they're saying, if we're going to give you money, we want a stake as well. We need cover for the taxpayer. So they're going with these deals where they're saying, like in this deal with Trilogy, well, we're going to take a $35 million equity stake, but also we're going to have 7.5% potential stake in warrants that give us some sort of cover that effectively act as a hedge. I mean, this is like the Wall Street mentality that has been brought to the White House, that's been brought to the DOD in particular. Steve Feinberg, who's the Undersecretary of Defense, Cerberus, like these are the kind of questions that they're putting out there to the market.
And also, though, Trump's supporters get something too, right? John Paulson has a big stake in this company,
yes.
And so he has doubled or tripled his money.
Yeah, and those are always going to be questions within the market. Who's actually benefiting, right? And at the core of this is the same question that we've always had with any other administration. It seems like you're picking winners and losers. Now, the administration pushes back on that, but very many investors in the market have said to me in phone calls over the past 4 months, oof, we are really in a winners and losers picking environment. And we're just going to have to see how it goes.
Joe, great to get you on set with us. Joe Doe there, our economic statecraft reporter. Coming up, President Trump eyeing talks with Democratic leaders as the government shutdown enters week 2. And he says he may not give back pay to furloughed workers. We'll head to Washington next. This is Open Interest.
I hope that the furloughed workers receive back pay. Of course, we have some extraordinary Americans who serve the federal government. They serve valiantly and they work hard and they serve in these various agencies doing really important work. I can tell you the president believes that as well. He and I have talked about this personally. He doesn't want people to go without pay, and that's why he pleaded with Chuck Schumer to do the right thing and vote to keep the government open.
That was Speaker Mike Johnson addressing federal worker furloughs and back pay during a news conference earlier this hour, at which he said also that some legal experts don't believe federal workers necessarily are entitled to their back pay. This is the White House considers not paying federal employees for the days they've been furloughed, even though President Trump signed the law, the Government Employees Fair Treatment Act, in 2019 that guarantees them that back pay. Washington correspondent Tyler Kendall joins us now. So, Tyler, this is going to be a real issue if they push it, or is this, like firing workers, just another bargaining chip for this administration?
Well, Matt, that's the big question, and we're going to have to wait and see whether or not the administration does follow through on these perceived threats. Now, as you mentioned, a person familiar with the matter is telling us here at Bloomberg News that this is an option on the table, according to a draft memo from the OMB director, Russ Vought. And the OMB appears to be taking aim at this 2019 law that you mentioned that was enacted after the last shutdown and is broadly seen as a durable legal basis for federal employees to get that back pay once the government reopens. But according to this memo, it appears that the OMB is arguing that those funds would need to be appropriated by Congress specifically, and that it is not an automatic guarantee. Now, if this does come to fruition, and again, this is just a draft memo, it will no doubt face legal challenges. And we have to keep in mind an estimated 750,000 federal workers are expected to be furloughed during the shutdown. So this would have some pretty broad-ranging impacts. It's definitely, though, heightening the tensions and increasing the pressure on these negotiations. And Matt, I would add two other pressure points to keep on your radar as this week continues on. One is on Friday, October 10th. That's going to be the first missed paycheck for federal workers. And the second is watch out what happens with WIC, the key federal assistance nutrition program. If that runs out this week, that's going to sound some big alarm bells.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall there from Washington, D.C. Coming up tomorrow, Danny Berger sits down with Thoma Bravo's Orlando Bravo. We'll also hear from PNC's Amanda Agati, Simplify's Paisley Nardini, and Mercado Partners CEO Joe Kaiser. This is Open Interest.